Diana, I can see you got your hand up. Welcome.
Hi, thanks for having me. I have a question. I am working on my first real business listing, and I'm trying to understand the recasting process, and I just want to make sure I understand this correctly. So, according to the BRG that I got from the IBBA site, it's the valuation can be either a percentage of annual sales, a multiplier for the seller discretionary income, or a multiplier for EBIT or EBITDA.
Yes.
And so I have their P&L statements for the last 3 years, and I'm trying to figure out what gets added back in. And my understanding is basically any salary that goes to the current owners, any potentially personal expenses like a cell phone, and then obviously depreciation and what is A? I forgot already.
Amortization.
Amortization, yeah, depreciation and amortization. And
Interest.
and then
Yeah, so
any seller, I don't know, do they have discretionary? Does this discretionary earnings also come out?
yeah, so what you're looking for is your standard EBITDA adjustments, right, are going to be your interest, taxes, depreciation, and amortization. So your interest, generally I recommend that you recast from tax returns, because the last thing you want to do is do your recast off of the P&Ls because you don't have tax returns, and then have them provide you with tax returns that bear no resemblance to the P&Ls. So lenders and buyers typically want to tie back to the tax returns. So I always recommend that you get both, and that you key off of the tax returns to the extent possible, and then you use the P&Ls to dive deeper into some of the expenses. So for example, on their tax return, they might have, under other deductions, there's usually something that says see statement 1 or whatever. And so on their federal statement, they would have a list of expenses. And one of those expenses might be insurance. And so insurance might say $68,000. And when you go over to the P&L, you might see that insurance is broken down into workers' comp and health insurance and life insurance and general liability. And so life insurance for the owners, you can add back, right? Health insurance for the owners, for the sellers, you can add back. So using the P&L to kind of identify some of those add backs and to get more detail is usually the way that I try and do it. Now, it's not always possible. Sometimes you get the tax returns and the P&Ls, and there's so many different categories on the P&Ls, and you have no way of figuring out how the accountant combined them to put them over onto the tax return. And so at that point, you kind of have to work off of the P&Ls. But hopefully your top line revenue and your cost of goods is some of your key things actually match or come close, so that, again, your buyers and lenders are going to want to look at the tax returns.
Well, we haven't signed with the client yet. They're just giving us this to get a base valuation. So given that we only have a P&L and they're
you have 3 years of P&Ls, or you only have 1 year of P&L?
3 years of P&Ls.
Okay.
Yeah, how would you get them a valuation?
I always require the tax returns. That's just my policy now, because I've been burned so many times, and early on.
Okay.
And so, yeah, so I won't give people a business value or anything else without seeing the tax returns.
Okay.
So my list, when I send a list of documents, I ask for the last 3 years of business tax returns, profit and loss statements, balance sheets, year-end balance sheets, and then an interim. Because right now, we're in April, So you should be able to get a P&L that is first quarter, right? January through March. And that'll give you some insight on how this year is going, which again, buyers want to see. So you could have a situation where the last 3 years have been really good, and then all of a sudden this year business tanked, and you need to know that up front, especially when you're trying to determine business value,
Yeah.
or asking price and all recommended asking price, because it could be that the business is just cyclical and that first quarter is always really bad, and that's fine. Then you say, okay, well, give me first quarter this year, a comparative P&L, first quarter this year versus first quarter last year, so I can see how they stack up. Or you can do trailing 12 months. You can ask them for trailing 12-month P&L. But yeah, in general, though, you still always want to see the tax returns because it's just important. If their
And that's
tax return is showing a $20,000 loss for 2024, and you add back your standard, your standard interest, um, taxes, depreciation, amortization, and that doesn't give, and officers' compensation or owners' compensation, and that doesn't get you a pretty reasonable number, then you're going to have real trouble finding a lender to underwrite any type of a loan, because the lenders don't like to go with all of the add backs being, travel, meals and entertainment, utilities, all their home utilities that they run through the business and all that. Lenders are not going to add all that back. Their appraisers might, but the lenders, for underwriting purposes, their credit departments are generally not. They have to draw a line because the guarantee, the SBA doesn't loan the money. The government is not loaning the money. The SBA is a guarantee fee. And so it's guaranteeing the loan, and but the loan has to meet certain criteria. And so the banks and the lenders, they have to meet the criteria that's set forth by the SBA, or their guarantee goes away if the business fails. So,
okay.
but
So
what kind of business is it?
it's a HVAC.
HVAC? Yeah. Um, I would just, definitely request the tax returns. Make sure that the tax returns, the top line revenue is pretty close. You could have a situation where they file their tax returns on a cash basis, and the P&Ls they gave you are on an accrual basis, and so your top line revenue could be off pretty substantially. But in that case, you just tell them, give me the cash basis P&L so I can match it up to your tax return, or have their accountant give you the accrual to cash conversion that was used to file their tax returns.
Okay.
So
But essentially you would use their tax return to get total income minus revenue, adding back interest, taxes, depreciation, amortization, and then whatever salaries and
yeah, your owner's compensation will be on there.
yeah, owner's comp. And
Yeah.
then
Is it a S corp or a LLC, or what
I
kind of
don't
business?
have that information.
Okay. So your tax return will tell you that too. And that is always good to know. Um, but yeah, you definitely need to work off of the tax return, because otherwise you're I mean, you can't get the business pre-qualified for loan. You can't, without the tax returns, there's just not a lot you can do. So, and I can tell you, Diana, in the past, like early on, in my career, I would do evaluations off of P&Ls, or there was another method that I was taught originally. And we would go to market, and, we'd find a great buyer and all that. And then I'd request the tax returns from the seller, and they wouldn't give them to me. It was like, and you burn buyers that way. So basically, you don't want to go to market without them anyways, because it's going to be a requirement for any lender. So unless you're dealing with a micro business where you're expecting somebody to come in with cash, if the buyer is going to be If you anticipate the buyer is gonna need a loan to buy the business, then you need to get all that up front.
Okay, thanks.
Sure.